Hello, friends. Welcome to this very special episode. As you know, we at Weekend Investing are creating data oriented content for users to learn along, to educate themselves, and also to appreciate how data focused strategies can really make a difference in your wealth creation journey. So, today is going to be another episode of that kind where I'm hoping that this focus towards data and structure is going to open some minds towards doing things in a rule-based, regular fashion. Now, what you can see on the screen is a matrix which is combining the effects of returns and the time spent in the market and the outcome that is achieved. So, for instance, if you have above average returns, but you don't spend too much time in the market, your wealth outcome is going to be insignificant. Let's say you got fantastic returns, annualized 200% returns, but you are there only for few months in the market. Your wealth creation journey is not happening there, right? But you can claim that I got 200% annualized returns. Your returns may be average. Maybe you have a portfolio that returns somewhere near Nifty, for instance. But again, time, you don't spend too much time in the market. You come in the market and you go away after a year. Your wealth outcome will be unnoticeable. There is no difference into your wealth that will get made. If your returns are, let's say, below benchmark, below average, and you've spent less time also, then really there's nothing to comment. I mean, you are just wasting time, making brokers rich by whatever commissions you are giving them. It's just a waste of time. On the flip side, if your returns are below average, let's say Nifty returns are 12%, you are able to make 10, for just for example's sake. But you spend a lot of time in the market. I mean, you allow that compounding to happen over 5 years, 10 years, 20 years. Then the wealth outcome is still very solid. This is something that people don't appreciate. Uh, Anything that is beating inflation and you're giving it time is going to build significant wealth for you. If the returns were near benchmark, let's say their average returns, and you also give a lot of time to this adventure, you will make very good returns, very good wealth outcome out of that. And in case you can do above average, above benchmark, which 80% of the active fund managers are not able to do. Okay, 80% of fund managers, PMS managers are not able to beat market returns globally. This is not India specific only. This is Pareto's rule, which is universal. Okay. Uh, and you also are able to give it time, decades, you will get extraordinary wealth outcome out of that combination. So you can see here that in this entire matrix, returns don't play that much of a role, right? But the time that you allow those returns to compound over makes all the difference. So regardless of where returns were in the top part, your wealth outcome was not so good. But regardless of where the returns were, with great time spent, your outcome was very good. So we need to, in some ways, not prioritize our focus just on returns, which unfortunately is the only focus people have when they come to the market is returns, returns, returns. Why am I getting 18 and he's getting 22? And why am I getting 22 and he's getting 25? Uh, that is not such a serious part of the wealth creation journey. What is that you need to stay in the market, you need to have long term plans, you need to not get scared when market falls, you need to not get into FOMO and bet your house at great market heights. All those behavioral things actually make up for most of your wealth creation journey and not your returns. So we want to spend more time in the market. We, of course, we want more returns also, but that is not our criteria for doing well or not. Yes, if we spend a lot of time in the market and we get a lot of good returns, of course our outcome will be much much superior. But if we spend a lot of time in the market and yet we can do reasonable returns, market returns, maybe even slightly less than market returns, we'll still be quite well off. So why can't majority people create substantial wealth? is because everybody is becoming short focused. The time is something that they don't want to give. Just look at this headline: 50% mutual funds get redeemed within a year. That is the situation that is there, and that is the same thing across asset classes. I mean, across geographies, people come to the market as if they're going into a casino, and we'll put some slots, we'll do some slot machines, we'll play some blackjack. If we make money, fine. If we don't make money, we'll get out. So the approach to the market itself is wrong. Okay. Now, this is percentage of equity AUM that has been invested for more than 2 years. And this is not such a old report. This is going till last year. So in the last 4 years, percentage of equity AUM that has been invested for more than 2 years has remained at about 50%. So 50% people don't want to keep their money in the market for more than 2 years. Or at least 50 percentage of AUM doesn't remain in the markets. 50% of people perhaps remain, but they'll take out their money. You make some money, you take it out. You make some money, you take it out. How will it compound? You are taking away the gunpowder for compounding, which is your gain every year. If you're going to remain at the base principle, you put in 10 lakhs, every time it makes 2 lakhs, you take the 2 lakhs away. Then it makes 2 lakhs again, you take 2 lakhs away. How will it compound? How will you grow? This is not just limited to India now. Now look at US equity holding period. It used to be near 5 years in 1975. It has virtually dropped to under one year. And the last decade, you have seen that minus one single year where people got stuck with a lot of loss making companies, so they may have held longer. Otherwise, the period was 1 year and below, 10 months actually. So this is becoming a timing game for most people. We want to come in, few months later, we want to get out. Markets are not designed for that in a sustainable manner. You may hit that jackpot once in a while, but if you keep doing that, overall, you'll make nothing actually. Average holding period in a stock on NYSE. Long-term average used to be as high as 8 to 10 years. Even during the 50s and 60s, it was 6 to 7 years average holding period. Now it is below 2 years. So even if you have identified a great stock, so somebody may have identified Apple or Microsoft or Google or Netflix or whatever it may be, they're not willing to stick to it. The average holding for any stock is going down. So what is the probability of loss in Indian markets if you don't stay around? Is a very interesting metric. So this last 79 April 79 to July 24 is the data period. So about 45 years of data is here. So which says that if you are in the market only for 3 months, then 38% of the times you may lose. It is still not a bad probability actually. I mean, 62% of time you're still winning just by blindly throwing a dart for 3 months. If you're if you're throwing a dart for 6 months, that probability of winning improves to 66% and loss to 33%. 1 year is the same. 2 years is where real difference starts to come. If you are in for 2 years, any 2 years, the probability that you will make money is 80% and above. If you are in for 3 years, that probability goes to nearly 90%. Only 10% of the time you will lose. 4 years is 9%. 5 years becomes almost 93%. 10 years is 99%. Any time during the last 45 years, if you had invested, there was a 99.29% chance that you would make money. And if you have spent 12 years in the market, any time during the last 45 years, there is no way you would have lost money. So you can see the impact and the power of spending time in the market. Your probability of winning automatically just continues to go up. But most people are trapped in this first segment, that they are in here for 6 months, 1 year, max 2 years, right? You should not be going lower than 3, 4, 5 years, in my opinion. More than 5 is ideal, but in this period, if you are lucky, you will get some fantastic returns. This is the zone of extreme luck. So if you are, you know, let's say 3 months in and 38% probability of losing, but you come in and you start winning, that is extreme good luck. So first couple of years is extreme good luck if you make money. Within 5 years, most likely you will do well. Most likely, very, very, very likely. But over 10 or 12 period, there is no way you will not do well. So, but very few successful investors, very few investors last till here to be successful. Let's put it that way. Now, this 2 year period is something that you have to sustain. If you are able to get, let's say somebody came in pre-COVID, the first 1 year was horrible because you were down 30%, 40%. But then in the next 1 year, it was more than made up for the loss, and you were from your starting point still in green. If you came in, let's say October 21, after that first phase of rally was done, there was a lull for a year and a half. If you got frustrated in that year and a half, you would have sold everything and gotten out. But then the next leg started. If you came in, let's say January 2008, from where the GFC started, the Lehman Brothers crisis started in that year. That year, you would have lost 60, 70% on Nifty. But had you stayed on for 2 more years, at least you would not have made any capital loss. Had you stayed on for another 4, 5 years, you would have been in green. Had you sipped through this journey, you would have come out much, much quicker. So many, many ways in which time really helps you, provided the market. Now, what is the CAGR that is needed to achieve multiples of amounts that you're expecting from the market? So, for instance, some people have this view that I want to come into the market and double my money. So, if you want to double your money, and you're saying I'm going to stay around only for 2 years, you need 41% CAGR. But if you are more reasonable, you're saying I'm happy if my money doubles in 5 years, 15% CAGR is very much possible, right? Or if you're saying, I'll go 5x of my capital, and if I get 18% over 10 years, I'm happy. So this part of the chart where is more difficult to achieve, the red part, is also the part where expectations are running too high. I mean, can you expect that you come in for 2 years and you do a 10x? So every year you will need a 216% returns. It may happen in a blue moon, but it can't happen every year, right? So expectations need to be moderated. You need to remember that the great of greats in the markets have had expectations this part of the table, not here. The best of traders are here, but then longevity of a trader, how they are able to scale within the frequency at which they are trading, all those are different matters. And of course, trading is a very, very different mental game versus investing. You need to be in a very zen like mode of your mind to sustain that. A lot of traders burn out within years because it is an extremely difficult profession to be at, and to do that consistently all through decades and decades. So recipe for sustained success, wealth creation in the market is very, very simple. Target average or above average returns. Don't target, sixers that I'll make 50%, 100% every year. But more importantly, you need to target that you're going to stay in the market for a very, very long time. Yes, if you have goals on the way, if you have some end of journeys on the way, take some money out if you have to, but then don't compromise on the long term compounding of your money unless it is really needed. So the only requirement here is not based on returns but on time, and you can make very good to extraordinary returns. Of course, we need to remember, as I did in a story recently also, Warren Buffett's CAGR over his lifetime has been 19%, which was not extraordinary, right? He didn't do a Jim Simmons at whatever 60% or whatever was that number, but his duration was very, very long. So already running 80 plus years now since he started. And that's where the kicker has come. Most of his wealth, 99% of his wealth has come post the age of 50. So it is possible for everybody to be there. Of course, we need to live as long. and for that you need to keep a good health and a stable mind. But returns specifically are not going to get you there. Time in the market with average or more than average returns are going to get you there. Please let me know your thoughts on this subject, how you are uh, positioning yourself for a long stint in the markets, what kind of returns you are able to get in a consistent manner, in the sense that you are not changing strategies every year, every 6 months. You're not jumping from one bucket to the other, trying out new things. It should be a also sort of an automatic path of just a exponential growth in your portfolio, which should come with basis some great rules, some great way of approaching the market, and then not getting bothered by the few months of very high markets or very low markets, and just you're sailing through the market as if you're not bothered about it, and you know that your path is leading you to the investing nirvana that you are going towards. Let me know your thoughts. Thanks. Bye.